Physicians are trained in the art of medicine, science, and healing. We call this the practice of medicine. But healthcare is a business. SMA's Business of Medicine podcast is designed to educate physicians on a wide range of business topics with the purpose of empowering physicians with the business knowledge they need to better enjoy the practice of medicine. This podcast is sponsored by SMA Services. SMA Services is a wholly owned subsidiary of the Southern Medical Association, founded in 1984 to address the business and financial needs of physicians.
Thank you, everybody, for joining us today. Hello, my name is Rob Mason. I'm the Director of 401k Development at SMA Services. Today, our guest is Mark Massey. He's Vice President of SMA Services, and today we are going to be discussing the topic of understanding your fees in 401k. Mark's going to share all of his 30 plus years of knowledge with us on some of these topics today. So just want to say hello to Mark, see how you're doing today.
Good, Rob. How are you?
I'm doing fantastic. Thanks. There's a lot of, I would say, misinformation and some confusion in the areas of fees, Mark. So I think we'd start out pretty basic of a question, just like, hey, why is it important for a plan sponsor, trustee, typically, the business owner, someone at the employer that's responsible for the plan, to understand their plan fees?
Yeah, Rob, the plan trustee, which is usually either the owner of the business or the CFO, is a fiduciary in the 401k, which means they are bound to act in the best interest of the participants of that plan. They're ultimately responsible for making sure the plan runs correctly within the compliance guidelines, and they must understand all the fees being charged to determine whether the total fees are reasonable per the Department of Labor. The paying excessive fees in your 401k plan is a breach of fiduciary duty of prudence. But what I've found out over all the years is I could count on one hand out of the tens of thousands of employers I've spoken with who actually understand the fees in a plan, because they were moving parts and a little complicated.
That makes sense. I agree that they're complicated, and it's interesting that as a plan sponsor, that fiduciary duty is real, and making sure you understand them, and yet most plan sponsors really don't understand. So that's good information to know why it's important to understand the fees. We hear a lot from time to time with clients or prospects that we hear, oh, well, I'm not paying fees, and whether they're talking about administration or general fees, we hear that often. Could you help us understand, someone who may think they're not paying fees?
Well, my pat response to that, Rob, is unless you're working with Santa Claus on this, there's nobody who does it for free. I mean, it's just like anything else. There's work involved and there's a charge for it. And to my knowledge, there's not any not-for-profit organizations operating a 401k for free. What gets confusing to people is there's 4 sets of fees within a plan, only one of which is borne by the employer. The other 3 sets of fees are all paid by the participants, which in almost all cases, obviously the employer should be a participant in their own plan too, but because 3 of the 4 fees are buried in the investment returns, which I'll explain in a minute, it's the only fee that they're aware of at all is their what I call billable fee, which is a check they write once a year to their third-party administrator for doing their discrimination testing, tax returns, the 5500s, and keeping the plan in compliance. The other 3 fees are internal.
Okay, well, that's, let's just dive right into that, because that's great information to understand the different types of fees and moving parts. So just to recap, the administration fees typical of what kind of work we do at SMA is the TPA, the administration work, and typically you were saying that as a billable expense to the employer. Is that correct?
Right. So let me just jump right into the 4 fees and explain how they work. And we'll take the easy one first. Every plan has to be administered. It's either done by a third-party administrator like SMA Services, and that accounts for about 95% of the cases. The other 5% are administered by the record keeper, often referred to as bundled plans. But it's the same result. You are paying a dollar amount for all the what I call I dotting and T crossing to keep your plan in compliance. So that fee is charged to the employer once a year, and it is either one of 2 ways. It's either a flat dollar amount or it's a flat dollar amount per an additional charge per eligible participant. For example, at SMA, we charge just a flat dollar amount, okay? And you know what it is. You're going to pay X amount, let's say $1,500 a year for your administration, and it doesn't matter if you have one eligible employee or 1,000. It's a flat dollar amount. But the majority of TPAs, and I'd say somewhere in the 80% range, if not higher, charge a flat dollar amount plus a per participant. And when they say per participant, they mean eligible participant because they have to be included in the testing and tax returns. That typically ranges from $15 to $25 an employee. Bottom line, if you are paying over $2,000 a year in administration fees, you're paying too much money and you need to contact us.
No, that's really clear. And so the administration fees, I think, correct me if I'm wrong, but I would think that out of all the 4 parts of the fees, that may be the section, since it's easiest to understand, that the employer may understand that they're paying.
Yeah, and I get that a lot. I'll say, well, I never just say, hey, what are you paying? Because I know what the answer is going to be. But they'll volunteer the information saying, oh, I'm paying $2,000 a year for my 401k. And, they know that because that's the only one of the 4 fees that the employer is actually stroking a check for. So it's easy to account for. It's on your accounts payable, simple. The other 3 that I want to get into now are deducted from the participant's accounts. So let me explain how that works. And I call it the 3-legged stool. You could call it a tripod. So let's address them one at a time. First off, the 3 legs of the stool are the record keeper, the advisor, and the mutual fund carriers. So each one of them has to be compensated within the 401k, and they each serve different roles. So let's start with the record keeper. Now, the record keeper is the company who you're sending the employee deferrals to, the match to, the profit sharing. Their role is to take the contributions and deposit them in the proper mutual funds, and let's call these buckets, because you'll have different buckets of money. You'll have employee pre-tax deferral. You could have employee Roth deferral, which is post-tax. You could have employer match, etc. So they account for the different buckets of money and make sure that they get deposited into the mutual funds that the participant chooses. Some record keeper names you might recognize is John Hancock or Principal, Mass Mutual, Transamerica. They're the person who a lot of employers will say, well, that's who my K is with, because it is. They're doing the record keeping. Now, your record keeping fee varies on 2 factors. Number 1, how much money is in the plan, and 2, who the record keeper is, because these record keepers play in different sandboxes. There are some that skew their pricing towards plans that are under $1 million. There are others that skew their pricing between 1 and 3 million, and others that go 3 million and up. But typically that record keeping fee is going to be about 35 to 40 basis points. And that's the amount that the record keeper is going to charge to account for the plan. So that's leg one. Leg two are the mutual fund companies. Within all 401ks, you've got a myriad of funds. Some people have as little as 5 or 6 funds in their plan. Some employers have 50. To me, the right number is somewhere around 20 because you want to cover all the different style boxes, kind of like the 31 flavors philosophy, where you want to have different flavors for different participants, i.e. money market, a bond fund, stocks, international, etc. Each mutual fund has a fund management fee that they charge to pay the money manager to actually trade the individual stocks and bonds within the mutual fund. Again, like everything else, this fee ranges because you've got different types of investments. For example, you could have what's called an index fund through, let's say, Vanguard, that would be relatively inexpensive, maybe 20 to 30 basis points, because that's not an actively managed or traded fund. They just pick 50 to 100 stocks and let them fly, and you make what you make. Where you could have a managed fund where you actually have a portfolio manager who's actually trading the stocks or bonds within the portfolio on a daily basis, that's going to have a higher expense factor because you got to pay them, okay, and they're actively trading it. The second factor in that is there's different types of funds. For example, an American stock fund is going to cost less than an international stock fund because you have currency exchange issues. I mean, you could have a tank driving down the street in some of these countries that you would not have in the United States. So there's other factors to be involved. But typically, those fund management fees are going to average, and it depends on the size of the plan, just like everything else. The more money you have, the less the fees are. But let's just say somewhere around 60 to 90 basis points. So where are we so far? We're coming up to 1% already because we've got the fund management fees plus the record keeper fees. Now, again, you could do a lineup of all index funds and keep that number down to, 25 or 30 basis points, and now we're still sitting around 55 and 60. It just depends. Typically, what you see happen is people have a mixture of funds. They'll have some index funds, they'll have some managed funds, international bonds, and then each participant can create their own portfolio by picking the funds they want. And just a tip here, just because of the mutual fund's expense ratio might be less than another, for example, Fund A might be 85 basis points and Fund B might be 20 basis points. But if the 85 basis point fund has outperformed the 25 basis point fund by more than 60 basis points every year, what difference does it make? You're making it up in performance. So it's just one of the things that the participants have to look at when deciding. Then the third piece is the advisor. Now, this is where it can have some range too, because every plan has an advisor on it. And this, you might call them your broker, their agent, whatever your name for them is. So let's start with their duties first. Their duties are they help the participants in the role of education. Their role is to do employee education meetings to help the participants ascertain which of the investments is most prudent for them. And of course, they charge a commission. Commissions range anywhere from 25 basis points to rarely do you see one over 75. So typically they're going to run around 50 basis points on the average. And that's the compensation that the advisor receives off the plan in order to pay them to educate your employees. So let's take some simple math to kind of tie this all together. Let's say you have a $1 million plan, just so we don't have to get our abacus out and do the math. We'll say the advisor's taking 25 basis points. So you've got 25. Let's say the record keeper's at 35. So 35 and 25 is 60. And let's just say your average mutual fund expense is 50. So if you add those three together, you're at 1.10, 1%, and then 110 basis points. So the way that these fees are paid, and this is why it's a mystery to everyone, is they are deducted off the rates of return that each participant earns that year. So let's just say for simplicity that you earned 11.10% for 2019 was your overall gross rate of return on the plan I just used the example on. Once you deduct the 1.10 to pay the record keeper, the mutual fund company, and the advisor, your net rate of return is 10%, 11.10 minus 1.10. So when participants get their, and employers get their quarterly statements or annual, or if they look at them every day, however they look at it, what they're seeing is their net rate of return, because that 110 is taken out on a daily basis. When you take 1.10 minus 365 days, it becomes 0.00. It's almost, Einstein couldn't develop, couldn't calculate it. So it's best to look at it on an annual basis and know that you're paying roughly around 1% on $1 million plan, and then everybody's roles is to do their part to earn it.
Great, thanks, Mark. Yeah, that makes sense. I'll just kind of recap just real quickly. We talked about the basic fee of the administration fee, and then we really went into the three-legged stool of the complicated part of the fees in 401k. So you mentioned the record keeper, the mutual fund cost, and then the advisor cost. And I guess my question is if I'm a participant and I'm saying, okay, I get all of that, correct me if I'm wrong, but I wanted to make it clear that when we talk basis points, 100 basis points is 1%. So when we say 50 basis points, that's a 0.5%. And what I like to do, because we get a lot of questions from participants in plans, if you have a $10,000 balance and your fees are this 1%-ish total for all three parts of your costs in a plan, you're typically paying about $100 a year out of that 10,000 or out of any returns. You talked about gross to net return, but could you comment on that? And is that a good way to look at it if you're a participant?
I wouldn't, and I can't even find employers who understand this because it's so complicated. A participant, what they're looking at is their rate of return. And, again, it's the employer who's the fiduciary on this plan, not the plan participant. So what I used in my example on the 1.10 was what I would call an average, but you could have, let's say, a startup plan that would have higher fees on all three of the legs because the amount of money that's in the plan, and that could be more like 1.75%, which would be 1.75%. And I see that all day long on plans that are, let's say, under $250,000. Then it starts getting, now that same 11.1% rate of return, now you're down to a little over 9 on your net. But participants just see the net, or what they typically do is they'll look at the page that has all the funds listed in the 1 year, 3 year, 5 year, 10-year returns, and then go what I call chase returns, which they'll say, well, the fund I was only in this year did 10%, but this International Gold Exchange Fund of South Africa did 23, so I'm going to move to that, which, sorry, you missed it. So it's better to pick a lineup that you're comfortable with for the long run and just stay with it, remembering this is a marathon, not a sprint.
Yeah, that's a good point to remember that, the two factors that you mentioned that do affect that total fee is, how much the total assets are in that particular plan, and then the particular record keeper that may be sponsoring the plan. So that's all really good information.
Let me add one thing to that, because this is something I see, and then we'll conclude. That one thing I see a lot is an employer, and I might start a plan at zero, but after, let's say, 7 or 8 years, because they've got 50 to 100 employees, now that plan is $4 or $5 million. don't expect your record keeper to come back to you and say, oh, you got 5 million now, I'm going to reduce your fees. But if you, because they're just not going to do it, they're too big of companies and you're lost in the, lost in the pile, and they just can't track it. Not knocking them, it's just something they're not going to proactively do. But when your plan hits certain barometers, 3, 4, 5 million, you need to go back to your advisor and inform them to go back to the record keeper and say, let's renegotiate the pricing on this plan, because when I bought it, because I had no assets, I was at 1.75%. Now I've got, let's just, what did I say? 3 million, that's going to be down around point. So you can knock a whole point off right there just by renegotiating, because that's going to come in around 0.75%. And that's 1% a year on your rate of return, just because you went and proactively. I mean, all employers should be either looking and at least shopping their plan every few years to make sure that they're getting the pricing, because in a good market and a lot of contributions, your plan's going to grow, and the more money you have in the plan, the less your fees are. But I guess my point being, don't expect them to reach out to you and say, hey, let me reduce your fees. You need to proactively go to them.
Yes, and I would think, since you recommend at least every few years, if not annually, to review your pricing, that's part of that fiduciary responsibility that we talked about at the beginning of the call here, in that it's a responsibility in to maintain reasonable fees. So that's great information.
Well, and I would recommend 1 year. It's kind of like the dentist, he tells you to come in 6 months, but you don't do that either, or most people don't. So I'm saying every couple of 3 years, hoping they'll do it that often. In theory, it should be reviewed every year, but I've been around long enough to know people just aren't going to do it that often.
Right. No, I agree. Well, to wrap up, if when we talk about reasonable fees and understanding your fees, and you talked about that three-legged stool, the tripod. So of course, I'm going to quote a movie quote. But how do employers or plan sponsors determine, is the juice worth the squeeze, essentially, and the cost? Am I getting what I'm paying for? How do you determine those reasonable fees? So if any listener today had a question or wanted to have a conversation with you, Mark, what's the best way to reach out if they needed some more information?
They can call me on my cell phone at 901-355-2559, or email me at mmassey, that's MMASSEY at SMA.org. This is what I do. It's all I've ever done. I enjoy talking about it, and I'll be glad to speak to anybody, anytime about these matters.
Great. Thanks, Mark. I appreciate your time today. Thank everybody for listening, and hope everybody enjoyed learning about fees in a 401k. Thank you.
Please consider supporting our mission by becoming an SMA member or making a tax-deductible donation. You can do this by visiting sma.org/donate.